drives the rate of return in the stock market and the bond market? We're going to talk about these two distinct numbers that every investor needs to know. So let's start with the bond market. When we're looking at the bond market, I'm going to bring up this chart here. This is going to give us a better understanding of how investors can think about long-term rates of return. And so what you can see here, this is looking at the current bond market with current yields between 5 and 7%, which is where we are today. And as you can see, this gives us forward year. In other words, what we're looking forward, what can we expect to see in the bond market for rates of returns? And as you can see, there's a green bar over on the left, that's 2.5 to 5%. There's a green bar over on the right, that's 7.5 to 10% average rate of return. And then in the middle, most of our returns, almost 80%, are going to be between 5 and 7.5% rate of return, which is exactly our starting yield or our starting interest rate. And so in the bond market, while there can be some numbers above and below your current interest rate, your current yield or the yield of when you buy the bond is going to drive the majority of your returns. So while the bond market has plenty of complexity, for the most part, what you need to understand is your current yield in the bonds that you own is what's going to drive your forward-looking rates of returns over the next 5 or so years. And so bond market, current yield, current interest rate, that's probably what you're going to see over the next 5 or so years in the market. And that's pretty consistent. What about the stock market? So let's bring up the similar chart, but as you can see, the bars are going to be very different. This is the stock market at its current valuation. And currently, the S&P 500 is trading at a 28 cyclically adjusted price to earnings. That's just a fancy term, but it gives us some context and a frame of reference for historically when the stock market has traded at this price, what have been the range of returns over the next 5 years. And as you can see, it varies quite a bit compared to bond prices. And so while bond prices is just the current interest rate, with stock prices, we've got average 5-year returns ranging from negative 5% over on the left side bar, all the way to positive 15 to 17%. And then we have all these bars in between. As you can see, the most common return number here is with negative 2 to 0% 5-year rate of return. And you're thinking, Kyle, this chart doesn't really make a whole lot of sense because I thought the stock market went up over time. And what's showing here is the most common bar, the most common experience I might see in the market is negative to 0 for 5 years. Why is that true? The number one driver or an incredibly important driver of your future returns in the stock market is the price you pay. And at 28, which is the current cyclically adjusted price to earnings, it's a mouthful, I know, at its current valuation, there is not a low likelihood of receiving returns that are not going to be what you're looking for. And so, okay, how do we fix this problem? How do we address this issue where we currently have an expensive market and there's some returns over on the left that we might want to avoid? Well, the way to do that is to look for areas of the market that are less expensive. And so I want to show you the same chart, but I want to give you a different look that's going to give you different prices. So right now, this is showing you a 28 price to earnings. Well, what happens when we start paying less? How does our range of return work? So this chart here shows you the same relationship. And so what you can see is if you move over to the right, you're paying more for the market. And if you move over to the left, you're paying less for the market. And as you can see, those dots start to shift as you move over to the right, which means you're paying more for the market. The dots start to shift down. Those dots are your 5-year returns that are expected in the market based on the price you're paying. So what does that mean? Well, we want to be up and to the left. Well, what drives being up and to the left? Paying less for an investment. So all else being equal, if we're able to buy the future cash flows of companies at lower prices, it increases our likelihood of success. And so the first chart that's showing these bars, that's where you've got all the way from negative to positive. It doesn't mean you can't get a positive experience, but what it does mean is there is not a 0 chance of you getting a negative experience, right? And of course, the future is unknown. There are no facts about the future, but what we do know about the market is the less you pay for an investment, all else being equal, the higher chance of your success. Because in the end, we're just buying future cash flows of companies. So if you can buy those at a discount, all the better. And the scatter plot, or the dot chart, if you will, instead of the bar chart, shows us that relationship. And so there's a reason the dots start from the top left and go to the bottom right. The more you pay, you can see a downward sloping line, which means the more you pay for an investment, the lower your expected rate of return. And so backing up, we're dealing with the bond market. What drives the returns in the bond market that we should expect? Your starting yield, your starting interest rate for the bonds you buy today or the bonds you own today. If you look over the next 5 years, it should be very close to your current interest rate that you see in the market. What about stocks? With stocks, you have a much wider range of returns than bonds. And so what drives that range of returns? It is the price that you pay. So with bonds, it's your interest rate. With stocks, it's the price you pay. And with both of those, as I always say, it's important to understand what you own and why you own it. I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.